Imagine waking up tomorrow and discovering that an artificial intelligence already knows what you're going to buy, what you'll invest in, and even what financial mistake you're most likely to make. It sounds like science fiction, but it's already happening. Every day, AI analyzes billions of pieces of data about human behavior, and in the process, it's revealing something surprising. Most money decisions aren't as rational as we think. For decades, people believed that financial success was mainly about intelligence, education, or access to information. But behavioral finance tells a different story. The biggest factor is often psychology. The problem is that our brains evolved to survive in the wild, not to manage money in a digital economy. We chase rewards, avoid pain, follow crowds, and make emotional decisions without realizing it. Now AI is exposing these hidden patterns at a scale never seen before. Think about online shopping. Have you ever opened an app just to browse and ended up buying something you never planned to purchase? AI systems study millions of similar behaviors and understand exactly which colors, prices, notifications, and recommendations increase the likelihood of spending. They don't just predict behavior, they influence it. The same thing happens in investing. When markets rise, people often become overconfident. When markets fall, fear takes over. AI models analyzing investor behavior consistently find that emotional reactions cause many people to buy high and sell low, the exact opposite of what creates wealth. What's fascinating is that AI doesn't judge these mistakes. It simply detects patterns. And those patterns reveal that human beings repeatedly fall into the same mental traps. One of the biggest is present bias. We naturally value immediate rewards more than future rewards. That's why spending $100 today feels easier than investing it for the future. AI can identify this tendency across millions of transactions, showing how short-term thinking quietly destroys long-term wealth. Another trap is social proof. We often assume that if everyone else is doing something, it must be correct. This explains investment bubbles, viral financial trends, and many costly decisions driven by fear of missing out. AI sees these waves forming before most people even notice them. Then there's loss aversion. Research consistently shows that people feel the pain of losing money more strongly than the pleasure of gaining the same amount. Because of this, investors hold losing positions too long and sometimes avoid opportunities that could improve their future. AI systems detect these emotional fingerprints in financial behavior every day. But here's the opportunity. The goal isn't to compete with AI. The goal is to learn from what AI is revealing about human psychology. When you understand your biases, you gain something incredibly valuable: awareness. Awareness creates better decisions. Better decisions create better financial outcomes. The people who thrive in the AI era won't necessarily be the smartest or the richest. They'll be the individuals who understand how their minds work and who can recognize emotional triggers before acting on them. AI is becoming a mirror that reflects our financial behavior back to us. Some people will use that mirror to become more intentional, more disciplined, and more successful. Others will ignore the reflection and continue repeating the same mistakes.